Welcome to Taking Stock for the week ending 2nd of June 2023, where myself, Tim Lincoln, and Kien Tren, our head of Stock Doctor Research, stream to you all things share market. Welcome, Kien, and how are you?
It's a bit chilly this morning in Melbourne, Tim, but I hope you're keeping warm and all our members are keeping warm as well.
Yeah, it is a bit chilly here in Melbourne town. But before we get started, Kien, just a reminder that all of the information we share today is of a general nature and therefore should not be construed as personal advice, and all of the performance metrics and data that we also share is of an historical nature and therefore should not be relied upon as a guide for future performance. Well, Kien, the month of May was a challenging one for the Australian share market, with the All Ordinaries Index down around 2.6%, while the Small Ordinaries Index fared even worse, falling by 3.3% over the month. And the drivers of this weak market sentiment has been the challenging bank reporting season, and more on that in a little while, but we've really been commenting on that through Lincoln Live and taking stock a lot lately, and higher than expected inflation figures, and of course the US debt ceiling.
Yeah, that's right, Tim. But positively, our star stocks outperformed the market over the month, with star growth stocks down only by about 1.7%, and that's helped by strong performances from some of the growth stocks like Jumbo Interactive. We had Kelsian Group and WiseTech, even Helia Group, and those lithium stocks, IGO and Pilbara Minerals, they really shot the lights out during the month. But our star income stocks, they performed in line with the ASX 200 accumulation index, returning negative 2.5%. And the main detractors there, Tim, and you mentioned that, came from the banks and also some of those retailers, which fell quite a lot over the month.
Yeah, they did, didn't they? But more positively, Kien, the Lincoln Australian Growth Fund and the Lincoln Australian Income Fund both performed really strongly relative to their respective benchmarks. And the Lincoln US funds, alongside the US market, performed better than the Aussie market, helped by stronger than expected results from global technology giants like Apple, Microsoft, Alphabet, Amazon, and NVIDIA Corporation. Collectively, Kien, these stocks represent around 24% of the S&P 500 index, and has also helped the NASDAQ rally some 6% over the last month. The stark difference between the Australian and US markets suggests that it would be beneficial to investors to consider diversifying their investments towards US markets, and it's a great way to do that is for members to consider our US funds for that diversification piece.
Yeah, artificial intelligence, Tim, seems to be the buzzword at the moment, helping those tech stocks. But the distinction between the US market and Australia is quite clear when you use the compare function in the Stock Doctor Advanced Charting tool. And you can see the Australian market index in black. And when you compare it to the US market in green, the US market is outperforming there. But you know, the pressure on the Australian market has continued this week, with resource stocks being weighed down by recent data on China manufacturing activity, which contracted for a second straight month in May. And that suggests that this post-COVID recovery is stalling in China. And Tim, you highlighted inflation rates, and this week, the Australian Bureau of Statistics, they released inflation data coming in at an annualized rate of 6.8% for April. And that's a rise from 6.3% in March. So inflation rates are quite stubbornly high at the moment. And this has prompted the market to increase their bets that the RBA will raise interest rates by 25 basis points next week. So the implied cash rate now is expected to peak at around 4.1% from 4% a week earlier.
Rising interest rates, not good, again, for a number of reasons in the economy, is it? But, you know, together with the ongoing inflationary cost pressures, will no doubt lead to more insolvencies, Kian. We've been harping on that for a long time now. Obviously, rising interest rates, strains on companies' balance sheets, unable to meet and service their debt commitments, will lead to an increased level of insolvencies. And currently, Kian, quite an alarming level now, and an increasing level, is about 78% of listed companies on the ASX are unhealthy. So therefore, especially those that are in distress, at risk of insolvency. So a real concern there. And the next chart on the screen displays a number of corporate insolvencies across various industries for the past financial year to date. And it's a massive increase, isn't it, compared to last year? There's been an increase of 65% of companies going bankrupt from a year earlier. That's a big, big increase, and something, again, that we have been harping on for a while as a real risk. And it's risen across all industries, although not surprisingly, the most vulnerable sectors are construction, hospitality, retail and manufacturing. And to compound this issue, Kian, banks and creditors are now less willing to extend debt funding to businesses, and the ATO has increased their pace of debt collection. So it is a very, very vulnerable period. But again, all the more reason, Ken, and we touched on this when we were preparing for today's recording, there's all the more reason why Stock Doctor plays such an important role in everyone's stock selection strategies and also portfolio management techniques. So not only helping to navigate through these challenging times to avoid these bankruptcies and insolvencies, but also when the going gets good and the bulls are running, obviously it really comes to its fore there. So Stock Doctor helps in all market cycles.
Yeah, Tim, those zombie companies, they're starting to fall over now, Tim. And just last month, we noticed 3 corporate failures, including we had recruitment company GoToPeople, also an early stage venture capital business called Caddy, and Australian gold miner Tombola Gold. So even though gold prices have shot through the roof, you're not immune, are you? And the common theme among these companies is that they've generated no profits and cash flows, surviving only on equity raisings from year to year. And unfortunately, those who've contributed to these capital raisings have lost everything, Tim.
Yeah, not good, Kian. Easily avoided though. Just focus on that financial health and the big red or khaki or yellow circle there for early warning. Those stocks are easily avoided. Really better off just focusing your energy and your time onto those high quality businesses, strong and satisfactory financial health. And again, helps you navigate through these more challenging market environments. However, Kian, where there's volatility, there's always opportunity, and especially across the small cap universe at the moment. And that because they're really still underperforming the market for this current year since really the start of the calendar year, or even longer. It actually extends a lot longer than that, as depicted on the chart on the screen. And when we're comparing to the ASX 200, we can really see that significant underperformance by the small caps, and that's again where Stock Doctor comes to the fore. Markets move in cycles, whether it be economic cycles, macroeconomic cycles, or even the cycles amongst the large and the small caps, mid caps. It's always rotating. Whenever we see these divergences in performance for an extended period of time, then you must expect that certain area of the market to have a run in the not too distant future. And we believe there's great opportunity there amongst the small caps, and members can find those small cap opportunities, obviously within the stock filter.
Yeah, we'll show you more about that later in the episode, Tim. But speaking about stocks that are cheap for a reason, we had Exstar stock during the week, Bank of Queensland. They are now under regulatory scrutiny for poor risk management policies. The bank is required to implement an action plan now to address these concerns, and failure to do so in a timely manner could open the bank to fines and, of course, weigh on their earnings and dividends.
Yeah, I see, Ken. And over the reporting season, Bank of Queensland was removed from the Star Stock income stock universe, even though their dividends still look attractive. Do you and the team think perhaps that dividend's not sustainable?
Yes, Tim, but one of the reasons was driven really by regulatory concerns for non-financial risks. And we mentioned this when we removed the stock, because that derails the market sentiment on the stock, and share prices has been falling as a result, which can offset the attractiveness of that dividend. And further compounding this is a number of other active risks, including the elevated levels of short interest, Tim, and also heightened industry competition, because it is a regional bank and not a major And of course, it was the only bank to cut its first half dividend, suggesting that management was not really confident in the outlook.
Yeah, and you and the team have got to be really confident in that sustainability of that dividend, don't you? So weighing up all of the active risks, then absolutely logic as to why you've now removed them from the Star Income Stock universe. But moving to another Star stock within the financial sector too, Kian, Challenger. They've really been under a lot of pressure, especially in regard to their share price. Why has it been so weak?
Yeah, Challenger, the annuities provider, price sentiment has soured over March, and that was really, if you can recall, due to developing crisis across those regional US banks, which led to a sharp decline in future interest rate expectations at that time, or otherwise known as bond yields. And this could potentially take the gloss out of the demand for annuity products, which pay income that are tied to those interest rate yields, Tim.
Yeah, but the company provided a trading update during the weekend, reconfirming its earnings guidance that is in line with the market expectations for earnings to rise some 14% this year. This could easily represent an opportunity for investors, especially given interest rates continue to rise. But members, of course, should be fully aware of the active risks before making an investment decision. So therefore, have a good read of the analyst comments to assess those active risks.
Yeah, that's right, Tim. And looking ahead with the corporate calendar, there's going to be another quiet week for Star Stocks, really because there's no results or companies expected to report or go ex-dividend. But we will continue to monitor any ad hoc announcements like they came out this week, and we'll keep our members updated very quickly on that.
And now to Under the Microscope, Kian. And this week we cast our lens over language testing and student recruitment firm IDP Education. The company's share price experienced a volatile reaction after Canada announced that it will be welcoming in 4 new English language test providers from August this year. Prior to this development, IELTS, which is an English language test owned by IEL, was the sole English language proficiency test for this visa program. And this has prompted the concerns that IDP could lose market share in the region. So, Kian, how will this impact on earnings?
Yeah, management didn't say too much, Tim, but on our estimates, the Canadian market contributes to roughly around 30% of total IELTS testing volumes. And presuming IDP's market share in Canada declines to approximately 50 to 60%, which aligns with the current IELTS market share in Australia, this would correlate to an earnings impact of around 9% from financial year 24 onwards.
Okay, and this appears to be a worst-case scenario, given that when a similar situation occurred in the UK, IDP only lost about 10% in its market share. However, Kian, will competitors reduce their prices to improve their market share?
Yeah, quite an interesting question. But we don't believe a price war will occur, Tim, because in competitive markets such as Australia and the UK, we haven't really witnessed changes to the pricing just yet. However, it is anticipated that IDP's marketing and sales costs could rise in an attempt for them to arrest their market share loss. And this could potentially weigh on their future earnings.
Okay, and with earnings expected to decline by around 10% in the worst case scenario, do you think the share price reaction this week was overdone? And on a valuation perspective, the stock is trading at a significant discount to its consensus share price target, which would appear to represent opportunity.
Yes, Tim, the share price fall does appear quite steep, but from a valuation perspective, we just need to be careful here because the downgrades to the share price targets and earnings have yet to fully come through though. Mm-hmm. And the stock is currently trading on a forward earnings multiple of around 40 times. And the uncertainty around its earnings beyond financial year 24 could mean that there could be a discount to this multiple in the next few months. But in addition to that, you've got potential investors should also be aware of other risks, including the recent change to management, Tim, as well, which we're paying close attention to, and also the high levels of short interest at around 5%.
Kian, you mentioned that some of the adjustments to the forecasts, the consensus forecasts, are yet to flow through. So investors and members really need to be careful at the moment about taking Golden Rule 3 criteria and data into consideration if they're about to be adjusted. When do you think those adjustments will flow through from the consensus analysts?
We're looking at around a week's time, Tim. Normally a week, that's when all the consensus numbers flows through, and we have a better ability in understanding these forecasts. But remember, management hasn't said anything about financial year 24 earnings, so it'll be interesting what the analysts come up with.
Okay, excellent. Thank you very much. I noticed that the stock has triggered an exit on SD30 TSR. So trend sensitive, especially those that are moderately trend sensitive, should be out of the stock if they're using SD30 TSR based on a really strong discipline in their portfolio management strategies. So Kian, given the risks, why has your team retained the stock under coverage as a borderline star growth stock?
Tim, we feel that this is still quite a great growth story over the longer term because the growth levers remain intact, and that's underpinned by this demand for migration and student placements from Asia into English-speaking countries. And despite the negative earnings revisions on screen, Tim, you can see that consensus estimates still allude to positive earnings growth for 24 and beyond.
And now to question of the week, Kian. And earlier in this episode, we touched on how members can find emerging opportunities amongst that small cap space in Stock Doctor. So share with us how they can do it, Kian.
Yeah, Tim, Stock Doctor has a very powerful filter tool which can help you generate investment ideas, and you can use Tim's preset filters to look for growth and income opportunities outside of your star universe. Quite a lot of ideas there. Otherwise, you can really build your own. And for example, let's create a new filter and we'll call it emerging opportunities. Then you can include fields such as star stock status. Here you're selecting non-star stocks. You're also selecting stocks with strong or satisfactory financial health. You want earnings growth greater than 0. So you want growing companies. You want to look for opportunities. So you're looking for price change 6 months. So those companies that have fallen by quite a lot. Looking for an average daily trade of greater than 50,000. So here you want a bit of liquidity to help you move in and out of stocks. And for companies with consensus forecasts, you can also include fields like 3-month earnings revisions to help you understand where earnings trends are going so you can avoid the value traps. And also forecast earnings growth. So you want companies expected to improve on their earnings as well, and having a forecast return on equity of greater than, say, 10% would be ideal as well. And then have price to consensus price targets, and that's a valuation measure. You want to see if there's any opportunities there, any companies trading at discounts. And of course, also include number of consensus analysts, because you want to make sure that the number of consensus analysts is quite high so that you can have conviction in those forecast figures.
Yeah, it's an interesting one, isn't it, Kian? Because with the consensus forecast for small caps, often there's 0 covering analysts. So just be aware of that one too, or very, very limited number of covering analysts. And for income stocks and income filter, you might want to include things like free cash flow per share, dividends per share, and gross dividend yield, franking, and ex-dividend date to understand when they go ex-dividend next, so you can sort of start to prioritize some of those trades. Then look for other opportunities by sorting on the 6-month share price change field, price to valuation, or gross dividend yield as well. So you can start to really dig in and find those opportunities. And when I say dig in, it's really important that the lists that are created from the stock filter are purely lists to explore further. So make sure after you're sorting and you sort of start to rank on the stocks you're most interested in, that you do drill in to those companies into their 9 golden rule screen and all of the other supporting screens along the toolbar to make sure that the stocks align with your objectives and, of course, meet your ethical and moral considerations as well, which is really, really important. So deep, thorough due diligence on those wonderful stock filter lists that you might produce. So good stuff there. But that's all we've got time for today, Kian. Hope our members have enjoyed another episode, and thanks for your contribution as always, Kian.
Yeah, it's a pleasure, Tim, and our team will always be there to help you as well. So if you have any questions on any of those emerging opportunities, feel free to contact our team and we'll be happy to help, Tim.
And we're there to answer any questions again on Monday morning too in Lincoln Live. So if you're a regular guest on Lincoln Live, then we're on again on Monday morning. But if you haven't tuned into a Lincoln Live session yet, then please feel free to do so on Monday, or we also make the recording available as we do with Taking Stock, of course. And just remember our end of financial year campaign. If you've got any family or friends who you think Stock Doctor would be of great use to, then please feel free to refer them also to us via our website, guide them to take up a trial where they will hold their hand and give them Rolls-Royce service throughout the month of June in order for them to make a good, confident, informed decision as to whether Stock Doctor's right for them. But just to recap a little bit, Kian, on today's recording, rising interest rates mean that financial health remains paramount in the current environment, as we see that increasing insolvency number. Even over the last few weeks, it continues to rise. So Golden Rule 1 is playing a really, really, really important role in the stock selection and management of portfolios right now. And the ongoing volatility, especially amongst the small cap universe and a lot of our star growth stocks too, represent really good opportunity because they have been oversold, we believe, through this recent cycle over the last year or two. So plenty of opportunities out there. But that's it for another week. Hope you've enjoyed it once again. Have a happy, healthy, and prosperous week.